Welcome to The Explainer. When we think about financial markets, we usually just see the numbers, right? A stock goes up, a stock goes down. But what if there's something much, much deeper going on? Today, we're diving into this idea that markets aren't just reflecting our world, they're actually building it. Let's get into it.
So, the traditional way of thinking about this is that markets are basically just giant, super smart calculators. The whole idea is that for any company out there, there's a true value, a correct number, and the market's only job is to figure out what that number is. But is that really the whole story?
Because what if that's all wrong? What if markets are less like calculators and more like powerful engines? What if the beliefs and actions of all of us in the market don't just find reality, but actually create it from the ground up? That is the wild idea we're going to unpack today. All right, to really get our heads around how markets can literally create their own reality, we have to talk about this fascinating concept, one that was really brought into the light by the investor George Soros. It's called reflexivity, and honestly, it might just change the way you see everything. So what exactly is reflexivity? Well, think of it like a two-way mirror or a constant feedback loop. It's not just that our thoughts about a stock change its price. That's the easy part. The crazy part is that the price then circles back and changes the company itself. Perception shapes reality, and then that new reality shapes our perceptions all over again. Let's just walk through a classic example of how this works. Okay, step one. It all starts in our heads. A bunch of investors believe a stock is going to be huge, so they start buying it. Simple enough. Step two, all that buying pushes the price up. The market reality has now changed. Now here's where the magic really happens. That higher stock price makes the company fundamentally stronger. Suddenly, it's cheaper for them to borrow money, or maybe they can now afford to buy a competitor. The business itself actually improves. And then, step four, that real-world improvement seems to prove the initial belief was right all along, which, of course, attracts even more buying. And just like that, the belief created its own truth.
This idea leads to something called a performative reality. It's a fantastic way to put it. The market isn't just a neutral observer sitting on the sidelines keeping score. No way. It's down on the field, an active player in the game, literally performing the value into existence. It's not just telling the story, it's writing it as it goes.
Now, this idea of reflexivity, it kind of blows up another big theory you might have heard about, maybe in an old economics class, the myth of perfect information, or the efficient market hypothesis. What if that whole idea has it backwards? Right, so the classic view says the market is perfectly efficient, any new piece of info is instantly priced in, which means you can't consistently beat it. But the deeper reality is, well, it's the complete opposite. It's the gaps in information. The fact that someone knows something you don't yet, or just sees it differently, that's what makes the whole thing work. Those gaps are what motivate people to do research, to take risks. Imperfect information isn't a bug in the system, it's the engine. And another thing, unlike some of those simple models suggest, markets are not goldfish. They don't just forget what happened yesterday, they have a memory. Big events like crashes or huge policy changes, they leave scars. They get embedded into the rules, into our behavior, even into the charts traders look at. The path the market took to get to today absolutely matters. Okay, so if markets are reflexive and information is always incomplete, what does that mean for the people actually playing the game? Well, it means the market isn't a math problem you can solve, it's a game of human psychology. This is a huge shift. It means being successful in this world isn't just about being the best at analyzing a company's balance sheet. It's about analyzing what all the other players on the field think that balance sheet is worth. You're not just playing the board, you're playing the person across from you. And this just creates what you could call an analytical arms race. It's like this. Level 1 is the basic stuff. What do I think this thing is worth? But that's not enough. You have to go to level 2. Okay, what do I think everybody else thinks it's worth? And then you go to level 3, which is a total mind bender. What do I think everybody else believes that other people believe it's worth? You see, it's this endless game of second-guessing and third-guessing human psychology. So let's take a breath. If the market is this complex, reflexive,
psychological mess. How can anyone possibly get ahead? The answer, it turns out, isn't about finding a better crystal ball. It's about a fundamental shift in your entire philosophy.
And here is maybe the most important mental shift of all. The goal is not to solve the puzzle. It's not about trying to predict the future with perfect accuracy. That's a fool's errand. The real wisdom is in just accepting that deep, fundamental uncertainty is a permanent feature of the game. It's not going away.
So what does that actually look like? Well, first, you stop obsessing over being right, and you start prioritizing managing your risk. You build strategies where the payoff is asymmetric, meaning you set it up so if you're wrong, you lose a little, but if you're right, you can win a lot. And maybe most importantly, you have to build up this psychological armor to withstand the pressure from the crowd and just accept deep down that you cannot and will not ever know everything.
Because at the end of the day, success isn't about trying to make the fog of uncertainty disappear. You can't. It's about building a better boat and learning how to navigate through that fog wisely.
And that brings us to one last really big thought. If markets truly are these engines of reality, powered by these feedback loops of human belief, then what are they really? They're a giant mirror. A mirror reflecting our collective hopes, our fears, our biases right back at us. So maybe the ultimate question isn't just what markets can teach us about money, but what they can teach us about ourselves. Thanks for tuning in to The Explainer.